Welcome to another episode of What's on Your Mind. In this episode, I'm going to be talking to Jason McDonald and Anthony Iser, and we'll be discussing their thoughts on what's been happening in the financial markets and the wider economy over the last few weeks. But as always, before we get into the show, I want to remind you guys watching and listening that if you're hungry for more information, you want to learn more about trading and portfolio management, then head over to our website itpm.com, where we've got a bunch of different educational resources up there ready for you guys. So things like our bite-sized presentation videos, our seminars that we do around the world. So we've got information on seminars on the website. You can check out if there's any local to your area and head along to one of those. I know we've got one in Hong Kong and Singapore upcoming, which I think Anthony is hosting, and some in Australia after that as well. And then we've got, beyond that, some premium educational content. So our online courses, they essentially teach you how to build and manage your own global multi-asset long-short portfolios. And then if you want to take that even further, you can do so with a mentoring program. So our mentoring programs essentially teach you how to practically implement all that knowledge that you've learned in those courses under the guidance and supervision of our senior trading mentors like Jason and Anthony, in a live trading environment. So with all that being said, let's get straight back to the show now. And Jason, I think we'll kick off with you this episode. What's been on your mind over the last few weeks?
Okay, I mean, not so much on my mind. It's virtually inescapable. The gift that keeps on giving, Brexit. So I'll just give, because obviously I'm London based, I'll give a quick update on that, but we won't dwell on it for too long. For fear of just boring people into submission. But so where we are, the latest is obviously, as everyone knows, unless they've been living on the moon with the Chinese explorer, that May lost her vote last week in what was a record defeat in parliamentary history. What might surprise some people outside of the UK is that she is still, believe it or not, trying to get a positive outcome in terms of that deal. So her latest gambit, she never says die, you can give her that, is that she's trying to somehow get some kind of guarantee on how long the Irish backstop might be in place. In other words, some sort of time limitation on the backstop, which is one of the big issues that people on both sides, whether they Remain or Brexit, actually don't like. And her strategy here seems to be that if she can get some kind of guarantee out of the EU, which is going to be difficult, if not impossible, that she can somehow bring the Brexiters over to her side. And actually, ironically, they vote for her deal on the basis that if they don't, then there's potentially no Brexit. On the other side of it, you've got which may be responsible for getting the pound going a little bit in the last couple of days. We're now going to have another vote next Tuesday, where some people on the absolutely no, we don't want to exit with a no deal scenario side of things, have introduced some measures to be voted on next Tuesday, which would, in the event that she doesn't, or there is no deal agreed or passed by a certain point in February, that basically the deadline of March the 29th would be rolled forward. So in other words, delayed. That got the pound going a little bit. And what it would mean is that they're talking about, if that happens, then it being delayed until at least the back end of summer, if not the end of the year. So that's where we are with that. In the meantime, actually, it kind of neatly brings us on to Europe. In the meantime, European economies are not looking too healthy. So we had December PMIs out for Europe, and three countries, two of which are relatively significant for the EU economy. Their manufacturing PMIs fell below 50, so that's France, Italy, and Poland. So below 50, as a reminder, indicates contraction in those economies. But of course, the big story is Germany, which is the biggest economy in the EU. As we've seen at the end of last year, the ZEW, which is their kind of business confidence survey, that's been dropping in the back end of last year. The latest German industrial production numbers came out. That saw a fall of 4.7% year on year, which is the steepest drop since 2009. So are we looking at, very anemic GDP growth in Germany this year? Probably. I won't say the R word yet, but I'll throw that out there. What price a German recession? Now, this is before Brexit has happened, right? So, okay, I'm sure some of the declining confidence is Brexit related. However, Europe is looking problematic already. And just to remind people that QE, as in net purchases by the ECB, finished very aptly at the end of last year. So we've got Draghi leaving his role towards the end of this year. Another bone I'll throw out there is what price that we have to have QE reintroduced by the end of 2019. So things are not looking too clever on the leading indicator front in Europe, basically. Looking elsewhere around the world, China, both the official manufacturing PMI survey and the Caixin Chinese PMI survey, they're now below 50. Chinese government has lowered its GDP target for this year from a range of 6 to 6.5%. To put that into context, the outcome for last year was growth of 6.6%, which was already the weakest since 1990. You've seen probably that last week, January the 16th, the People's Bank of China, the PBOC, injected 560 billion renminbi, which is about $83 billion, into the financial system. That's the highest one-day liquidity addition on record, double the previous highest liquidity addition of 270 billion renminbi a year ago. And that follows on from a cut in their reserve ratio requirement for the banks as well. I don't think we need to talk about Chinese banks. That's a well-rehearsed story in terms of how large the asset base is there. So I think that was the fifth cut in that reserve ratio of recent times. So, I'd say again, things not looking too clever in China. And maybe, Anthony, we can bring you in on that, and you could tell us what your thoughts are on that subject.
Thanks, Jason, and thanks, Chris. Yeah, I mean, there's headwinds everywhere, aren't there? So you've got broad China slowdown that you've just pointed to. You've got massive amounts of Chinese debt. China property company, listed property company in Hong Kong, down 80% just the other day because one day it had plenty of cash and the next day it couldn't pay debts. So all sorts of issues. And then on top of that, you throw in the trade dispute with the US, which, apart from not having any sign of ending, there's no clarity on what the actual desired outcomes are with this. And that's led the IMF to come out and say, look, we're going to downgrade 2019 and 2020 targets, adding in what you've just spoken about, Jason, with Europe under pressure as well. And just broad, sort of quite subjective things, but just things that impact risk appetite. China's locked up Canadians, they've locked up Australians in the name of national security. All these sorts of things just bring a broader concern to markets and a risk-off environment. So historically, one of the things people turn to as risk has become a larger feature is the gold market. I don't have a particularly strong view on the gold price per se, other than it's a safe haven in times like this. But potentially you look at the gold stocks. Jason, and I know you mentioned earlier offline that you had been looking at some of the gold stocks. Is there anything that you found that looks worthwhile?
Well, it's quite an ironic question, actually. If you've been to any of my seminars in the last few years, which I don't blame you for not attending, especially given your location. But no, on a serious note, we get asked a lot about gold. And the fact is that the old barbarous relic, people have been trying to call sort of the end of the downturn in the gold price for some time now, and as we all know, the stopped clock is right twice a day, so eventually they're going to be right. And to be fair, in the last few months, gold has actually rallied, not spectacularly, which is the way it sometimes behaves or mainly behaves. And so I've actually been fairly disparaging about gold in the past, but I think now, I think it could be looking a little bit interesting. And I'm not really looking at the gold price itself per se, although that has actually rallied a little bit. And I think, probably approaching $1,300 is a bit of a key level, at least psychologically. But actually, I've been looking at it from the miners' perspective. So there's an ETF out there listed in the US, the GDX, which is the gold miners ETF, which could be worth a look. And the reason I'm looking at it is because last week Newmont Mining, NEM is the ticker, they basically announced a cash and stock deal of $10 billion roughly in value for a thing called Goldcore. The combined company is going to become the world's largest gold miner in terms of market cap, production, and reserves. This is on the back of September last year, Barrick Gold and Rand Gold, which are two of the other big players in the market, they announced a merger. As with anything in life, when one person or a couple of people start to do things and it gets noticed, you can see a trend develop potentially. So I'm wondering, does this mean further consolidation amongst the gold miners? Particularly, I saw some comments in an interview on Bloomberg with a guy called Mark Bristow, who is the CEO of Barrick, who actually used to be the CEO of Rand Gold as well. Now, he was quoted as saying that without a doubt, this industry needs transformation. We believe we have started that, was the quote. And he's, spoken fairly vociferously about the need for gold miners and producers to basically consolidate and eliminate, extra layers of management or, lots of sort of overheads and stuff like that. If we put that into a background of the gold price is still below $1,300 an ounce, having been up as high as $1,900 back in 2011. We've got mine lives at multi-decade lows. As a result of the kind of ailing price of gold, as you would expect, you've seen exploration programs completely slashed. We see this kind of behavior in natural resources all the time. New discoveries are very few and far between. I'm basically thinking, well, all of this kind of adds up to potentially an environment where we're sort of ripe for consolidation. So I think it's worth a look at some of the smaller gold miners out there, and maybe having a look at the GDX ETF. And of course, as you mentioned earlier on, the gold thing sort of, if we're in a risk-off environment and, we've got a lot of negativity at the beginning of the year, despite the bounce that we've seen in markets, since the kind of oversold extremes of the end of last year, first couple of trading days of this year, then, potentially that makes gold a destination for funds, right? So I just think you've got a few things working in the same direction there, which makes it worth a look.
Yeah. Do you think that gold itself is an asset you could put your money in for that idea, or would you prefer to stick to the stocks?
I'm an equity person, so I generally believe that you get more bang for your buck with equity trades. However, I think you can make a good argument if you want to be well diversified. And you're looking at things from a multi-asset class basis, then of course there should be room in your portfolio for some gold exposure. I just think you might get a better bang for your buck if you look at those smaller miners. But I mean, I'm not talking about the micro guys that that maybe just exploration companies and don't actually produce anything. So I think you've got to be, you've got to distinguish. But I think that whether you express it through the ETF, through buying the underlying, or looking at the smaller miners, that there's something of benefit there. Personally, I'd look at the equities.
Anthony, do you have any sort of specific stocks that you've been looking at around the world, or any sectors maybe?
Look, I've got a couple of stocks, Chris, and one that came up in this forum a month or two before Christmas, discussion with Chris Cathy, was T-Rex, which is a US product. It's an interesting one, this, because I only became aware of it during one of the mentoring courses that we did. Jason and I went on a couple of years ago, and there's so many stocks out there. There's just undiscovered things all the time. And one of the mentees found it. It's a wood products company. They take wood, blend it with various plastics, and make flooring for outdoor decks and things like that. And it's been taking market share from the wood products market. It's been benefiting from renovation cycles, and they do a lot of work in the southern parts of America. So sadly, those hurricanes have led to lots of reconstruction as well. So they're doing well on that front. And it was really under pressure with the building material names and the wood products companies in the second half of last year, as that cycle appeared to sort of roll over a little bit. The housing starts and permits numbers just dropped away a bit, and the stocks got really hit. So the stocks since then is 20% off its lows. It's a good differentiator for that sector. It's got 20% earnings growth. So that looks pretty interesting, and it came up again in a conversation with a mentee. It just sort of stands out in that sector a little bit. So that was one. And I guess other conversations have tended to be around some of the bigger names at the moment, and that's pretty natural for people to go to those. There's obviously more press around some of these bigger names, and I couldn't help notice that Tesla is obviously, it's in the news all the time. Elon Musk sort of can't help himself, but they're cutting, by the looks of it, their X and S series production. They announced they're cutting staff by 7%. They've put their supercharging prices up in the US by 19%, which makes it now to run at current fuel prices basically twice as expensive as a Toyota Prius. Now, I know the buyers of a Tesla and a Toyota Prius are not exactly the same, but comparatively, it's becoming very expensive. And the thing is, this is a growth company. You don't cut production and you don't cut staff if a growth company is doing well. So it's always a risky short because of the potential for announcements of various descriptions that have happened. And there's big short squeezes, but I think that looks particularly interesting on the short side. It's just not stacking up as a growth company at this point in time. Another one that more from the potential for the buy side, and this is very much put it on a watch list. So as people who have done the course know, and the mentees that we have know, before trades get put on, they'll get on a watch list, and there's various hurdles they have to jump through to get into a trading book. And this one hasn't jumped all the hurdles yet. It's been under pressure, and that's Nvidia. The stock's down 50%. Obviously, big declines in growth outlook. Lots of it on the back of gaming computers and Bitcoin mining. But what they've done with this decline, they've announced that they're going to massively ramp up their buyback. So they've got a facility for $8 billion to buy back over the next few years, and potentially, if the stock's under more pressure, they could ramp that up quite quickly and see some benefit. Now, that's not the greatest way of using your capital, but they're generating a lot of capital at the moment, and if the share price is under pressure, it's probably a very sensible thing to do. So they make 500 mil every quarter in free cash flow. They have plenty on the balance sheet. EPS is strong next year, but flat to slightly down in the years going forward. So I don't think it's going to be about earnings too much. It's more just having strong support from this buyback, putting a bit of a floor under it. The reason why it's on a watch list, though, we don't know where that floor is. So we're just going to wait, keep an eye on it, and when we feel that has bottomed out, some of the momentum turns around, then our process will let us get it into the trading book, assuming everything else has remained the same. And I guess that the other big name that keeps propping up, and it came up with results recently, is Netflix, which adds subscribers at a pretty rapid clip, lots of them happening offshore given their reasonably consolidated market in the US. They're saturated is not the right term, but they've covered most of the bases. I still see risk in this company despite the very strong earnings growth. They have tens of billions of dollars in debt and outstanding expenses over the coming years for content. We're reaping the benefits, whether it's Game of Thrones on HBO or one of the myriad of Netflix shows that are now being nominated for Oscars. The consumer wins in this at the moment, but the share price is $1,000 per subscriber. At this point in time, that just seems way too much to me when the balance sheet is burning cash like you would not believe. Major competitor Hulu, who's obviously well behind in terms of subscriber growth and product offering, but they've just cut their basic service to $6 a month. And Netflix's basic service is more than double that. Now, that's very much at the margin, but the key thing to remember with Hulu is that Disney has a stake in it. Their stakes just got bigger by their purchase of Fox Entertainment, and they've said that they would be keen in buying out all the other shareholders and owning it outright. And Disney has a massive amount of content. It is the same market cap as Netflix, and it generates a significant amount more earnings and a massive amount more cash flow. So that's Netflix is another one I'd look at from the short side, but it is a quality offering. So if the volatility is low enough, maybe the safe way of looking at this would be looking at some options positions, so that if they do continue to win subscribers at a rate that impresses the market, and they can get that sort of market cap per subscriber number down, there might be some room for the upside, and options sort of will limit those, limit the losses if we've got a short position on. So I guess they're the sort of key things from the stocks perspective. I've just spent sort of the best part of the last month down on the beach in Australia. So yeah, well, look, it's a nice place to be at this time of the year, and Canada is one area that's freezing at this time of year. Everything sort of dries up, and I guess the housing market dries up a little bit, Jason, because that was another one you've been looking at.
Yeah, I mean, this is one that I've played last year. So I did talk about Aussie banks, which I'll come on to in a previous What's on Your Mind. But another trade that I did, kind of same theme really, was basically I was short of all of the 5 big Canadian banks last year in the second half, and bought them back, and they were quite nice trades. It took a bit of a while for them to work, and really we needed kind of the turmoil of the end of last year for those trades to really work. But as a result of the reaction since, they've now all 5 of them had a really decent bounce. So I've actually started shorting these again. Now, just to kind of remind people of where we are with Canada. So in terms of the most recent sort of economic numbers, we had November factory sales down 1.4% against an expected decline of 0.3%. We had wholesale sales falling 1% against expectations of a 1% increase. So that's actually the weakest wholesale sales reading since March 2016. Back in November, the Bank of Canada cut their real GDP forecast to 1.7% for 2018. That was down from a 2.1% in only a month before. So in other words, slowing down fairly rapidly there. In terms of the property market, volumes, this is with respect to, so Toronto home sales actually dropped 16%. That's volumes, not price. Vancouver home sales fell by 32% last year. So these are obviously, these are big, important markets in Canada property, and that they are some fairly dramatic decreases there. And as you'd expect, price growth is now virtually anemic. Now, we've had already this year, so this is pretty current, the CIBC, which is one of the big banks over there, their CEO already forecasting flat to low single-digit growth rate in mortgages for, as he put it, the foreseeable future. Basically, mortgage growth has already slowed markedly, and he's predicting that that's going to continue. To just revise some of the numbers here in terms of the ratios, so household debt to disposable income in Q3 was 175%. To put that into context, that peaked in the US at 137%. This is versus 175% in Canada Q3 last year. That peaked in the US at 137% in, you've guessed it, 2007. We know what happened after that. Now, I'm not predicting, that kind of a meltdown, but I'm just putting things into context here. You have household debt at 100% of GDP. You've got the Bank of Canada has actually been much the same as the Fed. It's been in tightening mode since July 2017. Their current central bank rate is 1.75%. Now, if we look at the interest rate futures market over there, it's currently predicting a 15% chance of a hike in April. Now, as recently as November, that market was predicting an 88% chance of an increase. So again, we're seeing, I'm not sure, I am sure that many people are looking at the Fed funds futures markets as well, and just have a look at how expectations have basically plummeted and then gone up again and then gone back down again, kind of much in line with what the equity market has been doing in terms of where people expect US interest rates to go this year. And of course, the sort of confusion is added to further by the jawboning from Jerome Powell. But the same thing's been happening in Canada. So, whereas before, as recently as 2 months ago, less than, you've got high expectations and confidence that that the Bank of Canada continues its interest rate increases. Actually, now that's looking like a much smaller likelihood. Of course, this all has got big implications for their housing market. So long short of it is that, well, actually the short of it is that I've just, taken advantage of the fact that these prices have all bounced back in line with the general kind of equity bounce that we've seen, and I've basically started shorting those again. So I think that is worth a look. So the big five over there, you've got Royal Bank of Canada, Toronto Dominion, CIBC, Bank of Nova Scotia, and Bank of Montreal. And then that kind of sort of neatly brings me on to, I'm going to sound like a perma bear on global banks, basically, because I'm now going to go back to the old, as we've talked about many times before, the widowmaker, as we like to call it, the short Aussie bank trade. You can actually make money out of this trade, as ever, with everything, or with almost everything. It depends on timing. So I've spoken about this previously. I've actually had the trades on. It's possible to be short of these banks and trade them. So I've been short of 3 out of the big 4 for most of the second half of last year. They did actually fall quite a bit in the interim, a bit like the Canadians. They rallied back In the case of the Aussies, they're all about 10% off their lows. I'm wondering, if you don't have a position on, is it time to look at this trade again? And I'll talk about why. Or if you do have it on, is it time to maybe add a little bit as well? So to give you kind of like the latest update with that situation, as far as I see it from the opposite side of the world, Aussie banks are now rejecting 50% of all mortgage applications. 50%, obviously half. A year ago, that rejection rate was 5%. In November, we saw average house prices in the 5 leading Aussie property markets falling 5.5%. In Sydney, they fell 8%. Melbourne saw a drop of 6%. Now, those two markets account for over half of Aussie housing by value, as you well know. Now, this was another interesting sort of tidbit that I only recently learned, was that at the end of 2015, about 40% of mortgages in Australia were interest only. Now, my understanding is that the way that these interest only mortgages work in Australia is that they start to amortize after 5 years or so, which means that you then have to start paying back, obviously, not just interest, but also part of the principal. Now, at that point, when that starts to occur, obviously your monthly payments are going to increase. And the numbers I've seen indicate that at that point, when they start to amortize, you're looking at a 30 to 40% increase in monthly payments. Now, the Reserve Bank of Australia estimates there are approximately 120 billion Aussie dollars worth, so that's about just shy of 90 billion US worth of interest-only mortgages that will need to be reset annually from 2018 through 2020. Now, I've seen some estimates. Now, these are clearly bearish estimates, which kind of obviously plays into my theme, absolutely granted. But I've seen estimates in some quarters that up to a third of those will not get refinanced, which is obviously, if that is the case, that is a serious issue for the Aussie banks. As you know better than I do, Anthony, the Aussie institutions buy these stocks for, amongst other things, for their dividend yields. But of course, nobody at the moment is assuming, or appears to be assuming, that there'll be any cuts to those dividends. And the analysts are really not in downgrading earnings mode yet either. So all in all, you put all those things together, I think that, we've seen a nice bounce in those prices, in their stock prices. And so I'm looking to, I've got limits in to start adding to my already existing short positions, which are, they're in the money, but it's been hard work, and they're not as much in the money now as they were at the end of last year. But still, I think that's a good trade. Have you got any thoughts about that?
Look, I think you're right, and I've sort of held the same view for quite some time. Anecdotally, which is always a risk of just being more confirmation bias of your own opinion. But when you look through the property market, what was an advertisement, for example, for a house that was, say, $1 million plus, well, now it'll have a range, or it may not even have a price. It might be priced on application. So the market's very unsure. So we could see volatility in pricing, which just adds to more uncertainty. It's interesting that these two markets are also, during the bull period running into sort of the early part of last year, were huge beneficiaries of Chinese buying and Chinese migration, and that stopped. So that's another part that I think adds to that thesis. And you mentioned debt to income ratios in Canada. In Australia, it's about 190%. It's really up there. Okay. So a major issue there as well. So I guess the way I'm viewing it is there's obviously a range of potential outcomes here, but I struggle to see where the positive outcome is in terms of house pricing and house volume. So that makes it a little bit tough for the banks on that basis. Then when you look at some of the activities of the banks, NAB today just raised mortgage prices 12 to 16 basis points. These are out of cycle rate increases. All the banks have been doing them, and they're trying to build buffers in there. So they're making things harder for the consumer, even when the official rates are not changing. And to that point, the view on Australian official rates has also softened a bit. So there is some expectation that the next rate move could potentially be cut or on hold. And that leads to an additional kicker in this short trade potentially, is that would lead to further weakening of the Australian dollar, because the interest rate differential with the US would look more unattractive than it is now. So you could see 5 to 10% off the currency as well. It was down about that amount, 9.5% last year, which would be sort of an added kicker to a short bank's position there. What we haven't seen is just the real economic gloom. Unemployment's still continuing to go along strongly. So we're not seeing the forced selling that really hurts a property market. But there is clearly that risk. Now, it's probably a small risk, but that's the risk that leads to a really bearish property market scenario. And in that circumstances, when you're getting forced sales coming through, that's when the banks are going to really get hit. And it doesn't even need to reach that for the dividend to be cut. But if that's the case, the banks start to look like they're under real pressure. That's, in Australia, historically, been a once in every 20 or 30 year scenario, hence the Widowmaker name. But at this stage, I can see your point, and I agree. I think it's sort of lining up on the negatives at this stage.
I guess the way I look at it is, what's my downside from being short of these things? So if I flip it around, I don't see many reasons to be buying those banks. Of course, as I mentioned, the dividend is one thing that attracts the Aussie institutions, particularly because, of course, because of the gross up. But that assumes that those dividends stay in place at the same levels. So, if you lose that support for some reason, then who knows what might happen. But I just think that for me, it's a relatively low risk trade. So I'm not even looking for a disaster scenario, to make money out of it. So anyway, we'll see. As we both agree, it's not exactly a new trade idea, but it's as often in trading, it's about timing. So we'll see how that one goes.
Okay, well, I think that's all we have time for in this episode of What's on Your Mind. As always, a pleasure speaking to you both, Jason, Anthony, and I think it will be interesting to see how some of those ideas that we've kind of looked at today play out in the next weeks and months ahead for when we catch up next time. As always, before we close the show, I want to remind you guys watching and listening, if you want to learn more about trading and portfolio management, as I mentioned at the beginning of the video, you can head over to our website, itpm.com, where we've got loads of different educational resources for you guys up there. So as I mentioned at the beginning, we've got live upcoming seminars. We've got one in Hong Kong on Saturday, January the 26th, one in Singapore on February the 2nd, and then a few in Australia after that, and plenty more to follow. So make sure you head to the website, check out those seminars and see if there's any local to your area that you can pop along to. As well as that, we've got bite-sized videos and our online video education courses that basically teach you how to build your own global long-short portfolios and manage your own money. And if you want to take that even further, you can do with applying to a mentoring program. So under the guidance and supervision of guys like Jason and Anthony, you guys can take all the theory you learn in those courses and practically implement it under their guidance in a sort of live setting. So that's all from us. I hope you guys enjoyed the show, and make sure you catch us next time for another episode of What's on Your Mind.